You've probably heard that gold is the ultimate safe haven asset, but have you been paying attention to its often overlooked cousin, silver? For centuries, silver has been a cornerstone of global economies, a symbol of wealth, and a crucial industrial metal. But today, something extraordinary is happening. The price of silver is on the move, and some experts are predicting a surge that could see its value skyrocket. We're talking about a potential scenario where a single bar of silver, right now priced around $80, could one day be enough to buy a car. Sounds crazy, right? But is it? Let's dive deep into the forces driving silver's potential rise. First, let's understand the basics. Silver is both a precious metal and an industrial metal. This dual nature makes it unique. Like gold, it's a store of value, a hedge against inflation and economic uncertainty. When currencies weaken or markets get shaky, investors flock to precious metals. But unlike gold, silver has a massive industrial demand that's growing every single day. Think about it. Silver is in your phone, your laptop, your solar panels, and your electric vehicle. It's one of the most conductive metals on Earth, making it irreplaceable in modern technology. Now, let's look at the supply and demand picture. For years, the silver market has been in a structural deficit. That means we're using more silver than we're mining. Mine production has been struggling to keep up, and inventories held in vaults around the world, like the COMEX and the London Bullion Market Association, have been steadily decreasing. This isn't a short-term blip, it's a long-term trend. As the world pushes for green energy and electrification, the demand for silver is set to explode. Solar panels need a significant amount of silver. Electric vehicles use more silver than traditional combustion engine cars. The 5G rollout requires silver for its infrastructure. All these technological advancements are incredibly silver intensive, so we have shrinking supply and soaring demand. That's a classic recipe for a price explosion. But there's another piece to this puzzle, the monetary aspect. For thousands of years, silver was money. The word for money in many languages is still the same as the word for silver. The US dollar itself was originally defined in terms of a specific weight of silver. While we moved off the silver standard decades ago, the memory of silver as real money lingers in our collective consciousness. In an era of unprecedented money printing by central banks around the globe, people are starting to question the long-term value of fiat currencies. They're looking for tangible assets, real money that can't be created out of thin air. Silver fits that bill perfectly. Let's talk about the gold to silver ratio. This is a key metric that traders watch. It simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has been around 15 to 1. In Roman times, it was 12 to 1. For much of the 20th century, it fluctuated, but today, it's sitting at a much higher level, often above 80 to 1. This suggests that, relative to gold, silver is incredibly undervalued. If that ratio were to return to its historical average, or even just move halfway there, the price of silver would have to increase dramatically, even if the price of gold stayed the same. Many analysts believe this reversion to the mean is not a matter of if, but when. Now, let's address the big claim, 1 silver bar for a car. Today, a standard 100-ounce silver bar costs a few $1,000s, while a new car can cost tens of thousands. This idea hinges on a massive revaluation of silver, likely triggered by a major economic event. This could be a currency crisis, hyperinflation, or a complete loss of faith in the current financial system. In such a scenario, the value of paper assets and fiat currencies could plummet, while the value of tangible assets like silver could soar to unimaginable heights. People would rush to trade their devaluing paper money for something real, something that has held its value for 5,000 years. The price of silver wouldn't just be a number on a screen, it would reflect its true purchasing power in a world where traditional financial instruments have failed. Consider the historical precedent. In post-World War I Germany, during the Weimar Republic's hyperinflation, it took wheelbarrows full of paper money to buy a loaf of bread, but a single ounce of silver could buy a house. While this is an extreme example, it shows how quickly the value of tangible assets can change relative to fiat currency during a crisis. We're not saying this is guaranteed to happen tomorrow, but the ingredients are certainly in place. Unprecedented global debt, geopolitical instability, and a fragile financial system create a fertile ground for such a revaluation. Let's circle back to the industrial demand, because this is what makes silver's story so compelling in the 21st century. The green energy transition is not just a policy goal, it's a global megatrend. Governments and corporations are pouring trillions of dollars into solar, wind, and electric vehicles. And silver is the key. Without silver, there are no solar panels as we know them. Without silver, the efficiency of electric vehicles is compromised. This isn't a demand that can be easily substituted. Scientists have been trying for years to find a cheaper alternative to silver for these applications, but nothing comes close to its unique properties. This creates a solid, non-negotiable floor for silver demand that is set to grow exponentially in the coming years. So when you hold a piece of silver, you're not just holding a shiny metal, you're holding an essential component of the future. You're holding a monetary asset that has protected wealth for millennia. You're holding a bet against the endless printing of fiat currency. And you might be holding something that is far more undervalued than most people realize. The price of $80 an ounce you might see today could look like an incredible bargain in the not-too-distant future. The journey of silver is just beginning, and for those who are paying attention, the potential rewards could be life-changing. It's a story of history, technology, and finance, all converging on one remarkable element. Let's re-examine the supply side in more detail. Over 70% of silver is mined as a byproduct of other metals, primarily lead, zinc, and copper. This means that silver production is not always responsive to the silver price. If the price of zinc falls, a mining company might shut down a mine, which also stops the production of the silver that came with it, regardless of how high the silver price is. This inelasticity of supply is a crucial factor. We can't just flip a switch and produce more silver when demand spikes. Opening new mines is a long, expensive, and difficult process, often taking a decade or more from discovery to production. And we're simply not discovering new primary silver deposits at the rate we once were. Meanwhile, above-ground stockpiles are being relentlessly drawn down. Think of it like a global savings account for silver, and we've been making steady withdrawals for years without making enough deposits. At some point, that account runs low, and when the market realizes this, the panic to secure physical silver could be intense. We saw a glimpse of this during the silver squeeze movements, where retail investors tried to corner the market. While they didn't succeed in breaking the market, they did expose the fragility of the supply chain and the disconnect between the paper price and the availability of physical metal. Premiums on silver coins and bars soared, meaning people were willing to pay well over the spot price just to get their hands on the real thing. This is a clear signal of stress in the physical market. Now, let's put this all together in a possible future scenario. Imagine a few years from now. The green energy push is in full swing. Solar panel installation is at an all-time high, and EV adoption has accelerated. The industrial demand for silver is through the roof. At the same time, a new global financial crisis hits, perhaps triggered by a sovereign debt default or a major bank failure. Central banks respond the only way they know how, by printing even more money, leading to high inflation or even hyperinflation in some countries. In this environment, investors and ordinary people alike lose faith in paper money. They scramble to find safety in tangible assets. Gold, the traditional safe haven, skyrockets in price. But as gold becomes too expensive for the average person, they turn to the next best thing, silver. The poor man's gold suddenly becomes everyone's gold. The gold to silver ratio begins to collapse, moving back towards its historical norms. Industrial users, desperate to secure the silver they need to manufacture their products, enter a bidding war for the dwindling available supply. They are forced to pay whatever it takes, passing the cost on to consumers. The price of a phone, a solar panel, or an EV would reflect this new, much higher silver price. It's a perfect storm. Demand from both investors and industry converges on a market with limited supply. This is the scenario where the price of silver doesn't just double or triple, it goes parabolic. It's in this world that the idea of trading a bar of silver for a car moves from the realm of fantasy to a plausible reality. The purchasing power of silver would be restored, not just as an industrial commodity, but as true, sound money.